Hello, ladies and gentlemen. This is Jesse Colombo, Cyber Trading University's Forex and Futures instructor, and we have an exciting closing bell webinar today at 4:30 with Pat Barham of Trade the System. He's going to be discussing different strategies to trade during the holidays and maximize profit and minimize risk. And the holidays are some of the most interesting times to trade, even though they're very low volume trading periods. I've seen some of the most explosive rallies occur right around or right after Thanksgiving or around Christmas, around New Year's. So, and also even some of the summer holidays. Sometimes you see in right around 4th of July, you can see some of the most explosive moves. So he's going to be discussing how to go about trading that and capture those gains. So, but first I'm going to be discussing my daily Forex and Futures recap. And right now you can see the S&P 500, my typical starting point. You can see it's down a bit today. And part of the reason why it's down is because of today's unexpectedly strong CPI inflation report, which many traders and participants were expecting the data to come in really to show deflation, basically, and that increased the probability of a more dovish Fed. But now you have this strong CPI report come in, and now it increases the probability of the Fed being a little bit more hawkish or more willing to tighten sooner than expected. So you can see this market's just getting knocked around all different ways. And so here we go. I'm going to show you what I'm watching. It's the same thing I've been watching. You can see still that same rising uptrend line. Nothing's changed with that. We still have the same overhead resistance, which is the high that we saw back in late February. So there's been no confirmed signal yet, in my mind, at least according to the systems that I use, where I'm just seeing it's just bouncing around back and forth between the support and resistance. So if it could finally break above, then that'll be the all clear signal. But if it breaks down from here, that'll be a bearish signal. So I'll be watching that closely. But right now it's all about the Fed, as usual in the last 7 years. It's all driven by what will the Fed do? Will it continue to print money or not? Or will it keep rates at zero or start to raise them? So it's all eyes are on the Fed. To the point where fundamental data really just has fallen by the wayside. It's really all about central bank money printing at this point, which is many traders consider to be jokingly a centrally planned economy at this point. It's hard to disagree. So this is the Dow, and you can see it's in a similar formation as the S&P 500, just bouncing around back and forth. It's still above 18,000, but barely. 18,000 is the key psychological support level I've been watching. So we'll see if it bounces from there and if it acts as a real support. Let's take a look at the tech-centric NASDAQ 100. You can see right here, it seems like it's been bumping its head at that resistance, which is the same February high I've been watching. So tried to touch it a few days ago, just couldn't break right away. So I want to see if it's going to bump its head and then possibly sell off and touch this rising uptrend line for now. So that's what I'm looking for. All right, let's look at the Japanese Nikkei stock index. You can see it's in that channel that it's been in, and it's been slow. You can see the momentum's been slowing down because it's near the top of the channel, but it's been hugging the top of that channel line, which is a good sign for now. But according to this, it's a little bit overbought, so I want to see if it's going to either pull back by either going flat or if it's actually going to pull back all the way to the bottom of this line. So I wouldn't be buying up here. The time to buy was either at the secondary entry point when it broke this resistance line right after that consolidation we saw in early March, or preferably when I first showed this breakout from the wedge back in late January. So that was a pretty nice run of 2,400 points. So not too shabby. All right, let's take a look at the U.S. dollar. So it's at that key uptrend line level right now. It's right on a support. it's not only, it's actually on two supports, as I've been saying. It's this rising uptrend line, and also the support that marked the high of that consolidation that we saw back in January and February. So this is a really crucial time, not only for the dollar, but for other currencies, but also commodities like oil. Everything is tied algorithmically at this point. So many of these algorithms are tied directly to the major currencies, the US dollar and the euro. And commodities trade inversely with the dollar and in a positively correlated manner with the euro. So if the dollar actually does bounce from here and continues on like it has many other times, then it's going to most likely punish commodities and non-US currencies. If it drops below, it'll support this recent commodities bounce that we've been watching. So this is really very important. I want to see if there's going to be what the catalyst is going to be over the next few days or next week or so. Definitely very interesting. But if it does rally, it's the US dollar index I'm watching the next price target as being this high that we saw in a couple weeks ago. Basically the high. I want to see if it's going to rally back up to the highs, because prior highs end up being price targets and resistance levels. And the euro, which just looks like an inverse version of the US dollar index, is also it's just underneath that downtrend line. And this is very interesting because you can see it tried to rally right above earlier today. And it also tried to rally above $1.10. This is the euro versus US dollar currency pair. So that's a key psychological level because it's a round number. And it's also close to the lows that we saw back in late January. I'd say this is some sort of a resistance zone rather than one particular level. It seems like this zone is between 1.1 and 1.11. So overhead resistance plus this downtrend line. Tried to rally above, couldn't do it. It's sold off. So that's very interesting and notable. So now I want to see if it's going to try to correct back and retest those lows right around 1.05. And if it does, it'll drag commodities down with it just because they're so tied together. Commodities barely even trade on supply and demand figures anymore, fundamental figures. It's all about what's the dollar doing, what's the euro doing. It's a very counterintuitive market from the way most people are trained to think about finance and economics. Let's look at the dollar yen. I'm still watching that wedge. So you can see it pull back a bit. And now it's right on that support line. So similar to the US dollar index, I want to see if it's going to bounce from here. Also watch 120 because it's a key round number, likely to be a psychological number. And if it can manage to rally back above there, the next level it's probably going to try to hit is 122. So I'm not predicting, I'm just reacting. That's all I'm doing. I just watch these key levels and I take a wait and see approach. Whereas a lot of people on Wall Street they're trying to make these projections into the future where will the euro be in September 2015? I don't do that because I do not know in advance how markets will react at certain key levels, nor do I have to. I just watch when it gets there and then manage risk accordingly. This is the US dollar, Canadian dollar, and you can see it looks very similar to the dollar yen. And of course, because it's another US dollar based pair, so you can see similar wedge type of breakout and then retest. I want to see if it'll break below or if it's going to bounce from here. And any bounce that we'd have in this currency pair and also the dollar yen will most likely coincide with the bounce in the US dollar index. Assuming that is what happens, I don't know. But I'll be watching intently. Let's take a look at the Australian dollar. Australian dollar's rallied quite a bit over the last few days. And now it's back at this resistance at 0.79. So you can see it was in a range between 0.76 and 0.79 to the US dollar. So you can see, similar to the euro, the way it tried to rally early on in the day. I think it was in the European trading session. And then when the U.S. CPI report came out, the dollar firmed up and knocked down all the other non-U.S. currencies. So you can see how it acts at those critical psychological levels. So I want to see if it's going to have a follow through and try to break above, or if it'll be unable to and then retest those lows back at 0.76. Okay, let's see what else we have here. All right, let's take a look at oil. I've been following oil so closely. So,
Yeah, Jesse, I'm here.
okay. All right, Pat. I'm just finishing up, and we'll be able to test shortly. So, all right, you can see this is West Texas Intermediate crude oil. It's been in this trading range between $44 per barrel and $54 per barrel. So, tried to break down last week, March 16th, proved to be a bear trap, which is basically where a market or asset falls underneath a key technical level and then rallies back above, and then it basically catches all the shorts who tried to short on that breakdown, and then creates a little bit of a short squeeze. The main trigger behind this was the U.S. dollar index's pullback after Janet Yellen's testimony last Wednesday. So once again, it just shows that Forex is the main driver of commodities movements these days. And we had at 10:30 a.m. Eastern, we have a crude oil inventories report coming out in the United States, and that could be a big catalyst that could determine which way crude oil is going to head, whether it's going to retest 44 and maybe break below, or if it's going to continue on in this rally. So these inventory numbers have been constantly surprising the market by coming in higher and higher than expected. So that has been the main bearish factor for crude oil, even though the dollar has really been pulling back. So I want to see if the dollar can rally off that rising uptrend line I showed, then it'll punish oil. If on the other hand the dollar experiences a breakdown, then I wouldn't be surprised to see oil continue on, rally up maybe to 54. If it breaks 54, that'll be another bullish confirmation. And then it's possible that this could be a double bottom, where you have the first bottom back here in January and then the next bottom in March. So again, I'm just, what I do is I just keep an open mind when I approach these markets. I don't have a set view of how things will play out. I put out multiple views, multiple theories or theses of how I expect that things can play out. And then I watch for reactions. I watch for confirmation. Like if it breaks down, then the bearish scenario may play out. If it breaks out, then I'm looking toward the bullish scenario. So that's really how it is. Let's take one look at gold really quickly. You can see its rally. It's continuing after breaking out of this downtrend channel line I showed. I was also showing 1150 as a key support. Or at least this zone, I would say, right around 1150. It's not a single number, rarely is. So you can see the breakout is still intact. Now we're coming up at 1200. Should be a key psychological level, as it's been for 2 years. So I want to see if it's going to encounter some resistance there. And if you're following gold, watch the U.S. dollar index. If the U.S. dollar index bounces off that rising uptrend line, then gold, it'll probably put the kibosh on gold's rally, and maybe it'll try to retest back at 1150. If the dollar breaks down, then I wouldn't be surprised to see gold head up back to 1300, which is the prior high. So that's a likely target. So, all right, folks. So I'm just going to take a quick pause, and then at 4:30 and for about 14 minutes, Pat will come on, and we'll have an interesting presentation about how to trade during holiday trading sessions. So, speak to you then. Take care. Hello, ladies and gentlemen. It's Jesse Colombo. Thank you so much for your patience. So I'm excited to announce that Pat Barham is going to be starting his presentation. Pat has been an active futures and equities trader for over 30 years. He's seen so many different types of market scenarios, and from all the way back in the day when they used paper chart books that you filled in by hands until the age of computers. And he's had the opportunity to trade almost every type of futures contract known to man. So he's going to be teaching us different strategies to trade during the holiday markets, and I'm definitely going to be interested in watching this because I've always seen so many exciting moves that I wanted to be able to take advantage of, but from time to time it get cold feet because you see low volume and volatility. So Pat's going to teach us how to go about this. So all right, Pat, looking forward to it.
Jess, thank you so much. Guys, I want to thank you for being patient with me here. Again, as Jesse said, I've been around for over 30 years, and you should expect things like this. If you see off of Microsoft PowerPoint, I'm showing you, you aren't getting the full picture that normally you would be seeing because of some type of glitch that my computer's having that's with Omnovia. So you get to see sometimes the good, the bad, and the ugly when you do a webinar, and this may be part of it, that it's not going to be the polished side that you would see, but what I'm going to be talking about today is a holiday trade. And why am I showing a Christmas tree when it's March 24th? The reason is because it's kind of like a lasting memory that will be there, is that around holidays, strange things happen in not only the agricultural side of the market, but I think in all aspects of the market, that we begin to see things happen that are just very profitable for us as traders. And a little bit about myself. I started as an institutional grain trader. And what is that? I was working for a company called Clayton Brokerage Company, and I went to work and worked with a lot of elevators and processors, people, end users and growers alike in the agricultural side of the business prior to becoming a commodities broker. And as I did that, as I came to that business with a pretty much a knowledge of the agricultural side, back when I started trading, the biggest contracts that were traded were in the grain markets: corn, soybeans, wheat, soybean meal, soybean oil, cattle, hogs, back in the days when people would call them bellies, pork bellies. And then as things progressed over the years, we got the proliferation of other contracts in the market, so you could pretty much trade anything and everything. And I've traded most all of them, from the metals to energy markets. It's like I've told a lot of people, if it grows out of the ground, if you can dig it out of the ground, I've pretty much handled it at some point in time. And I stayed in that business for a number of years and decided that I would prefer to be out on my own. And I went out on my own several years ago, and back when my kids were small, because it gave me an opportunity to travel around the country and pretty much trade and do what I wanted to do whenever I wanted to do it. And I've been trading for a living for, basically for 30 years, but it was different types. When I first started, I was trading for a living by working with other people's accounts and working with other people that wanted to trade the market. Well, I learned a lot through them, because when you trade millions of dollars worth of commodities, you find out how different people trade. Some good, some bad, and some just strictly out of nowhere. They just kind of wake up in the morning, make a decision, and go with it. And I'm sure, like you guys, that there's a lot of people here who would love to trade, just love to trade for a living. If you aren't doing it, it may be something that you aspire to, and that's your desire. So that's where I came from the institutional side of the business. And for you, if you're just getting started in it and you're doing it professionally as a professional trader, for families that are watching you, that's probably one of the hardest things for you to do. Now, what I'm going to show today is one of the, I think this is probably one of the best setups that I had over the years, because as a holiday trade, you can also kind of put a hyphen in here, holiday / seasonal type trades along with this. Now, and I'm going to include this too, because anybody who's done this, you've got to include this in there, which is a warning for if you don't have the money. Basically this: if you can't afford to trade, don't do it. Don't trade with money you can't afford to lose. And everything that we're doing here is not giving you an exact trade to put on, but what it's doing is hopefully educating you so that you'll know that when it's time, the best time for you to put on a trade. There's a lot of risk to it. You can lose everything you've got, so that's why we put this warning up. Now, I'm going to put something up here, and it's called the Voice of the Tomb. I don't know if any of you guys, have y'all ever heard of Voice of the Tomb, the history of the Voice of the Tomb? And what this is, it is supposedly a legend of a grain trader that made a fortune trading grains. And that once he got old, his wife died, and as he got old, his kids thought they were just going to inherit a boatload of money. And to make a long story short off of this, he wanted to make sure his kids earned their money. So when he died, he gave all his money away, but he left the Voice of the Tomb. He left the instructions that he worked off of for years on when to buy and when to sell grains. And this old grain trader died, and he left this behind. Now, the Voice of the Tomb, off of this, would it still be a viable trade setup? And over the years, what's changed with this and the driving force behind the dates for these trades. And that's what I want to touch on with you guys. Back when I first started trading, and you can imagine 30 years ago that the internet was not around. So how did you learn how to trade? When I started, I had the opportunity to I was in an office with several other people, some old cotton traders, some guys back when I started 30 years ago, they had been trading for 30 and 40 years. And they had ways to trade, and most of them were set strictly on fundamentals. And the fundamentals at those times were, they would try to get all the government reports they could get. They would read over them and see how the position trades that they would put on, especially in the commercial side of the business. People were looking a whole lot longer out than the end of the day. They were looking for months ahead of what they would have to buy and sell, or what they needed to use to process to operate, whether it was somebody like Pillsbury. People traded with large farm operations. I traded an awful lot of cotton because I'm from Memphis, Tennessee. And at that time, cotton was a really big futures that I traded. We traded an awful lot in just the outright corn, soybeans, and wheat. And also along rice through the years. At one time, I was one of the largest rice traders, but when you look at the size of the rice contracts these days, you think, well, that's not a very big contract. But if you're trading any contract and you're a big portion of the open interest, you get a little bit antsy about that. But we did that even with rice, people hedging rice. Now, in this, the voice of the tomb, there's got a lot of different scenarios that you could go back and look at the dates off of the voice of the tomb and look at it and say, why did that work? Why did the market go through reversals at these times? And have any of you guys seen? It's this slide's coming up here. Do y'all remember this movie Trading Places? Any of you guys have seen that from years and years ago? With Eddie Murphy when he was, and Dan Aykroyd when Eddie Murphy was really young. Yeah, a few of you guys. Yeah, y'all remember what drove that market in Trading Places? You remember what they were really focusing in on? And if you've never traded before, this is a relic now, because what they experienced then does not exist anymore. Yeah, they were trading orange juice. Now, do you remember what was going to be the driving force behind the orange juice trade? Anybody remember that? That's right. The crop report. You remember the two brothers in there that were just making a bet to see if when this report would come out, what would happen? Well, that's pretty much what we're looking at today in certain aspects of the market. Now, if you've traded the E-mini S&P and the YM, the E-mini Dow, you know that the FOMC day can make, which we just had one, can make a huge impact in the market. Now, when you get USDA crop reports, when they are released, and they can make a huge impact in the market. You don't have to necessarily know what is in the report. The key part of any crop report, or I think any market release of any information, is when it comes out. Now, if you were going to be trading corn and soybeans, would you know what dates these crop reports come out? The situation that it may be on the end of this month, March the 31st, we've got a very big report coming out. What is that report? It's going to be the USDA Acreage report. Do I care what it says? I don't give a flip what it says. The key is this, is that you know where these come out and you know what time they come out. Over the years, we had traded these reports. They would release this information at 7:30 in the morning Central Time. And all the times that I mentioned are going to be Central, because that's where the exchange is, and that's where I live in Central Time Zone. They changed it a few years ago. Now, the Acreage reports come out at 11 a.m. Central, the major reports. So what do you need to do? You need to find out how to get these reports. You need to know when they could, really what you need is you need the calendar of when these reports come out. The major reports, like I said, are going to come out at 11 a.m. Central Time. Now, we've got this Acreage report coming out. I think this was last year, the chart that I'm showing up here now. When we came out with the June 30th crop report, this market made a 74-cent move from high to low. This is like a 74 handle move in the S&P. Because if you've never traded the grain markets, the corn, soybeans, and wheat trade the same increment as the E-mini S&P. Each tick is $12.50. Each 1 cent move is $50. So this move that we had here was a $3,600 move in 1 day. Now, what would have happened if you had been out playing golf and you would have forgotten that these reports were going to come out? You'd been sucking wind. It would have been something that would have possibly decimated an account if you had a lot of contracts on. Now, why is all this important? Over the years, things have changed in the agricultural side of the market. And what has changed so much? Years ago, you take 50, 60 years ago, you'd go out and this time of the year, you'd see a guy driving around on a tractor. It looked like this. Now, things have changed. You might be driving around now, pull out in a field, especially if you're up in Illinois or Iowa, Indiana, you may see a planter like this that's about by the looks of it, it looks like it's about the size of a football field that you're pulling behind a tractor. Now, what's important about this? Well, it just, times changed. Back when the Voice of the Tomb came out and supposedly came out, that was back in the early 1900s when people were reporting on that. And a lot of things have changed. Now, back, and this is, 6, 7, 8 years ago, before 2008, that slide on the left there you would see, and it would be, that was the pit. Now, in the trading pits of the Chicago Board of Trade, you had all your orders that executed for the pit, open outcry. Now, after 2008, this is one of the last pictures I've got, that's the one on the right is what it looked like probably 2 or 3 years ago. What has happened? Now that we've gone to electronic trading, the open outcry in the grain markets that once existed basically is no longer there. There's a lot of pits that are shutting down this year. The energy markets, for one, those pits will cease to exist anymore. So what is the pit now? You are the pit. You are trading in the commodities pit, per se, which is the modern day pit of the world. Before, everything ran through Chicago. Now it runs through a desk, whether you're sitting on the beach or up in the mountains. I don't care if you're on the East Coast or the West Coast, if you're in Japan, no matter where you are. My son plays professional basketball, played basketball, and I have to throw in a little bit of a homie type thing here. Go Gonzaga. My son played basketball at Gonzaga last year, and this year he's playing basketball in Japan. And the Zags are doing pretty good, and hopefully in the Sweet 16 they'll keep going. Now, he's got a lot of time on his hands overseas, and he can go log into his account and trade from Japan just as easy as I can from Tennessee. Now, back to what we're talking about. There's certain reports that you need to know when they come out, and some of them you can pick up these reports and also get a good indication on what managed money is doing. One of them is called the Commitment of Traders Report. You can Google this and pull it up very easy. And you can pick up a lot of information off of the Commitment of Traders report. You would also need to know what the most important information is, and you need to know how to read these Commitment of Traders report. Why is this important? You can go into the energy markets, you can go into the financials, you can go to the equity side of it, or you can go into the agricultural side of this Commitment of Traders report, and you can tell what managed money is doing, which is just millions and millions of dollars. And are they reversing? Are they adding to positions? What are they doing? When you learn to read what these reports are doing, it will help you in your trading. Now, around a report, one thing happens. You get a lot of volatility. Market volatility around a report sometimes can put you in a position to hold a trade for, it could be a month, it could be for days, it could be for weeks. It just all depends on what your time frame is. Most of you guys out here who are trading, are y'all scalpers? Are you day traders? Are you position trades? And also, let me ask this question. How many of you guys out there have traded the grains before? Let me get some idea there. Yep, nope, never. Nope, yeah, Jesse has, nope. Most people have not traded the agricultural side of the market. A big majority of the people haven't, because it's kind of like a dark hole. People don't know how to treat it. But when you look at soybean, when you look at corn, the open interest in corn is probably 4 or 5 times bigger than the YM if you've traded the E-mini Dow. And most people don't know exactly how to handle that, because they think it's something really, they hear limit up or limit down, and it scares people off. Well, the limits are so far now out that it would be very rare for us to get limit moves. Plus, with us trading almost 24 hours a day, that's another situation that's changed from years ago. Back 20 years ago, yeah, you could get stuck in a limit move, mainly because most people position traded and they did not day trade. I will teach you, I'm going to be doing a webinar, and this webinar will be in April, and it will teach you, and I'll spend time in that webinar teaching you how to trade the grains, whether it's scalping or whether it's position trading. And I'll teach you some of the setups that you can use, some of the things that can identify to help you make some pretty good moves in the market. Such as this, around this report, and this one would have been the early March that we've got coming out probably just in the next few days. The end of March, this particular one, and in 4 days, the soybean market moved $4,700. Now, how do you trade these moves? That's what I'm going to be showing you in this webinar. Ways that you can take advantage of it. Am I going to tell you an exact trade to take? No. It wouldn't really do you that much good. But what I'm going to do, I'm going to show you what to look for, and for you to use your setups and your parameters, or either the ones that you can follow along with the way that I do it. I'll show you that and show you how to take advantage of these moves. I go in most of these trades, and my total risk is it's very rare that it will be more than 8 ticks risk, or $100 per contract. If I'm trading 8 contracts, I'm not risking any more than $800. Now, if it doesn't hit in the right spot where my stop would, I place my stop, I may have to move it a tick or maybe two, but that's usually about it. For me to have anything more than a 10-tick stop would be really unusual. It may take me a couple of times to get positioned in here, but there's some trades over the years. I know one of the bigger trades on a per contract basis was right at a $20,000 per contract trade that I made, and that was in the little bit over a 30-day period. Could you do that? Yes, you can do that. With a holiday trade and what I will show you in this webinar, that's something that is very easy to show you. Now, off of two sides of trading, you have to understand when you begin to look at the agricultural side of the market, that you've got speculators and hedgers. And how do you find out what they're doing? I mentioned the Commitment of Traders report, and this is one of them right here, going back into June of last year. And it shows you what the managed money is doing. And it also shows you, are they short? And at this point, you're seeing they're increasing their short positions. You can take a look at managed money, and here we've got soybeans. And off of the managed money here, you're also seeing that the longs in June of 2010 were beginning to liquidate short or long positions. What happened? Well, when you go back in and start to look at it, there were some pretty major changes happening in the soybean market. Here's the corn market. It shows you how many contracts were short and what they were doing. They were adding to it, and this was June the 10th. And it shows you also the changes from week to week, what these were doing. Seasonalities are based on these historical trends that we've got in the market. In the voice of the tomb, that's what that guy was trading. He was trading seasonalities based on historical trends. Now, it really doesn't make any difference to us if the market's going up or going down. We just need the volatility and the change. We need the also how we can take advantage based off the rate of the change. You may not hold a position overnight. That would be fine. Once you get into these trades and begin to build some profits and you get some cushion built in them, you can trade in and out of them and re-enter trades as you get the fluctuations to be able to get back in on a pullback, whether it's getting into a bear market and the market's making a rally, you can get back short again. You can just trade it so many different ways, and that's what I'll be showing you here. Now, market trends have changed a lot in the past years for these reasons. The seasonalities are based on these historical trends, but now we're dealing with an international market more than we ever have before. Why? Because when you look at what's going on in the agricultural market, just as we look now in the financials, money is coming in from everywhere. China, if you were looking at fundamentals in the market and you were wanting to know what how much corn, how much soybeans, whatever it is, wheat, how much China was buying, you'd be in this slide I've got right here. Look at the difference between like 2003 and 2013. The difference that China is making in the agricultural market. We also have this. The exports. Where are these exports coming from? The United States is not the sole grower of like wheat, corn, soybeans anymore. Matter of fact, it would be very easy for Russia to take the lead and be the top wheat grower in the world. South America, they can have a crop that can exceed ours in soybeans. We're still very strong in all of them. But things have changed. Like right now, we're getting ready to plant corn, soybeans. Wheat is growing right now. It will be harvested in the latter part of May, early part of June in most areas. We will be planting basically starting now in the southern part of the United States where it's warmed up. Crops are going in. And that will take place for a number of weeks. And that's why this crop acreage report coming out at the end of this month is so important. How many acres are going to be grown? Because it's going to move the market. It's just one of these reports that it's going to move it based on the amount of acres that we have. Now, we've got our crop being planted in South America, soybeans, corn, they're wrapping up their harvest now. And it's a huge crop to go along with it. So what's that going to do? This is what I call that you've got to be aware of is the new voice of the tune. There's a kind of a new way to take a look at it. Trading futures with a system that you've got that you know when these are going on. A lot of people believe that the grain markets, it's a sleepy market that just doesn't move very much. It's not very exciting. Well, I can show you how you can go in here in the grain markets, and it was even more pronounced a few years ago when we had the opening of the equity markets at 8:30 in the morning, and then the grains would open at 9:30. Now they all open at the same time. I used to love trade the first hour of the equities, and then go in and trade the first hour of the grain markets. And my day was usually finished within 2.5 hours that I was finished. Now, also in the webinar that I'll be sharing with you guys, if you choose to join in on it, I'll teach you what the holiday trade is, why it continues to work, and most important, how do you identify when to make the trades? We do that in a way that it's not just a very segmented time once a year. There are an awful lot of trades that we've taken all throughout the year, and I'll just give you a heads up on it. One of the best trading days of the years for this setup comes about on Memorial Day. We just went through a period of time where we went through different holidays, and believe it or not, anytime we get a 3-day holiday in the market, you go back in and look at some of the changes in the agricultural side of the market, you'll notice that there's oftentimes some things taking place. Well, do you jump on those on that particular day? Not necessarily. But I'll show you when to get in, when to really be honed into these markets, when the trades are most advantageous, and also how to trade with it to give you some pretty high probability trades. It's not unusual for me, and I just caught one of the trades at the beginning of the year that I was in soybeans for a couple of weeks, and I had about a $5,000 move in soybeans. And how long did I hold it? It was about 3 weeks. And the most I risked on it at any one time was $100. The first day I put it on, it went in my favor. It started moving very well. When I put it on, I moved it to break even and set on it, and it never had a day where it closed against me. Is it going to happen again? I expect it to, but it may not. But that's something, part of the trades that I'll show you as we go along. We trade the system. I work through our website and our trading room. It's tradethesystem.com. It's a live trading room, and we're doing continual live trades in there all morning long. We're start about 8:15 in the morning, go to about 11 o'clock Central Time. And we're continually providing live commentary along that way, whether it's in the financials or stocks or grain markets, whatever it may be. So that's something that I'd like for you guys to take a look at. You can look at it, tradethesystem.com, and we've got a trial membership in there if you'd like to do it. We also have something called Hump Day Hangout that we do every Wednesday that gives you a pretty good idea on what we're looking at. We use it also for about an hour and a half's worth of education when the market closes. And we're really enjoying doing that Hump Day Hangout. And also, now, is it just something I've mentioned, the grain markets and all that? Is it something where you start looking at the holiday trades for only agricultural products? No. When you start to go back in and look at the equity side of the market, you can see here on Apple, and most of y'all know what happens at the end of November, especially in the United States. What happens? Well, this was a holiday, and there was a pretty big move in Apple on that particular time. At that time frame, when you take a look at it, I think this was this past year when we were looking at Apple, and you saw the move that we made there. Can you catch those? Yeah. Is it work? The same setup that I'm using in the ag markets, the same setups that I use in the ES and the YM, it works in the equities also. Also, when you start looking at correlations in the market, I don't know if you've ever looked at it, but you'd be surprised, and I called a nice trade in the corn today because soybeans were down, wheat was down, and so I jumped in a market that was pretty dead and made a nice gain, which was my only trade of the day because I was so busy doing some other things. I caught a nice little move in corn. Well, how did I know to do that? Basically, it's pretty easy. The wheat and soybeans told me. And I've got a trade that I'll show you guys in the webinar called my Three Sisters trade. And what is it? The Three Sisters. My wife and her two sisters, when you put them in a pack, when one does something, the others pretty much follow along. You see geese. I love duck hunting down here in the South. Have some great duck hunting, and you see geese and ducks fly over. They don't fly over one at a time. Usually, when you see one group when you see a goose, it's going to have some more with it. They're going to fly in formation. When one gets up, the others follow. If something scares, if there's a pretty good flock of geese out on the water and one of them gets up and takes off, you see all of them move. Same thing with the ducks, and it's just nature. People who trade the corn usually are looking at beans and wheat to go along with it. And if one trades, the others usually follow suit. Now you can see here on these charts, the moves here. Look at the trend that they got. The grains are very trending markets, very good markets to be trading if you're a trend trader, which I am. I don't like counter trend trading. I would prefer to be trading with the trend. And one of the things that we do in the webinar is help you stay on that side of the market. Now, you can also see here, back in September of 2014, most of the people here in the United States know that the first part of September, there's a holiday there. Well, what happened? Corn, you can go back in and look at it. Corn made a pretty nice move. Then you can also go back in when we saw some of the highest moves that we had back even in 2011 and show you that it just isn't a once in a 1 year type flash in the pan. Corn had a pretty good move back in October off of this. Pretty nice trade through that. Now, it's not unusual in 20 trading days this particular contract, and this was corn, in a 20-day period, it had an $8,000 move. Now, that's pretty massive, especially if you're trading, and that's just something that we also cover in the webinar, is if you trade the options market, if you trade the ETF. The futures contract isn't the only thing that you can trade and make money off of it. We can look at ETFs, you can look at the options and take a lot of different avenues toward making some pretty nice gains in the markets. Now, there's also one in here that I haven't mentioned called live cattle. This was in November last year, where we came in here after Thanksgiving and given everybody a heads up on this particular setup that seemed to be taking place. And over about the first half of December, the cattle gave us about a $4,000 move. And if you've been to the grocery store lately and looked at the price of ground beef, steaks, whatever you're buying, you know that this is something you deal in probably every day. The only thing is you don't look at it as in the futures market as being something that would be really a trade for you to put on. Cattle is not a big contract. It's a very technical contract, but when you do get in on it, it can make you some good, very good profits because it's also a very trending market. You can see here where it moved from just what I'm showing here in September to the November, from 152 up to 172, a 20-cent move. That's about an $8,000 move in the market, and then reversed it and to a little bit more than a $4,000 move. Now, what we also cover is when it's best to use fundamental or technical analysis for the short-term trading. I very rarely use any fundamental analysis. Everything I do is technical. But I do look at fundamentals because sometimes if we're in the midst of a drought and we've got areas all over the United States that have no water and the crops are drying up and burning up, you know, that's fundamental. You need to know what's going on, especially in long-term trading. And regardless of the analysis you use to make a trade, you still have to make a decision on what to do. And the question that you've got to ask yourself, you've got to find out when you come in and start looking at some of these trades is what your time frame is for these trades when you do the holiday trades, how much money you're willing to risk to potentially catch that $8,000, $20,000 move, whatever it may be, and what your profit target is off of those trades. And that's what we do. We try to help you do that. And on the webinar, we're going to spend at least a couple of hours in the webinar going over the strategies, the process, the executions on what you need to be doing, looking at different ways to trade it, looking at the different instruments that you could go into. There's still a very good trade in soybean meal, soybean oil, and I'll touch on some of this stuff to give you some setups and some strategies that you can begin looking at it, and you won't be passing up a market that is a very, very profitable market for a lot of people. Especially, I like to tell people, if you're a new trader, the corn market, I believe, is one of the best markets to learn on. I'm very strong on in Fibonacci and Elliott wave analysis on the very short-term stuff. I'm not one that's looking at grand super cycles and all this stuff. What I'm looking for is just the short-term stuff and how you can apply some of the Elliott wave and some of the Fibonacci price retracements and extensions and things like that to the market. And that's what we do. I go over there and show you that and the different time frames and how to use different time frames to come up with some real extreme high probability trades. Guys, that's about it. That's about all I've got. And again, tradethesystem.com. If you go to And let me find where it is here. There it is. TradeTheSystem.com/go would be the link for you to go to sign up for this webinar. Again, it's $97. You can come in and through that, we also offer a trial for our trading room. And $97 is pretty inexpensive when you find out what we can churn out on these trades for you. Again, if you go to tradethesystem.com/go, that's what will lead you to the page where you can sign up for our webinar here. And guys, Jesse, that's all I've got.
All right.
To lead in on that. And
all right. Thank you so much, Pat. It was a wonderful presentation, and we hope to have you back. All right. Take care, folks. You're welcome.